Hello, everybody. Today I want to come to you with a little presentation. So I'm going to try a little something different. Speaking to you about life insurance and living benefits, because most people do not think that life insurance is actually for life. Living benefits. There are living benefits to life insurance. Um, So this would be like what is called the new life insurance, because nobody thought about life insurance as being living benefits. And for those who are already aware and educated on this type of product, already know that this is an IUL, which stands for Index Universal Life. So you will see right here. Index Universal Life. So living benefits, put the life in life insurance. So F&G is one of the companies that I am appointed with. So let's just break it down and go through this little flyer right here that I have of my material. So how each living benefits rider can help you in times of need. So living benefits referred to in your policy as accelerated death benefit riders. They are ABRs. So they give you access to your death benefit when certain conditions are met. So you have to meet certain conditions to trigger the event. So we offer critical illness, chronic illness, and terminal illness riders. So what happens if you get sick? Access your death benefit while you're living so you can focus on the people and the things that matter most to you. So facing a critical illness, the critical illness rider allows acceleration of up to 100% of your policy's death benefit for conditions such as heart attack, stroke, cancer, organ transplant, ALS, also known as Lou Gehrig's disease, and then more. So managing a terminal illness, if your life expectancy is under 24 months, you can accelerate up to 100% of your death benefit. Battling chronic illness, if you are living with a diagnosed chronic illness or impairment that impacts 2 of 6 activities of daily living, you can accelerate part of your death benefit. So this covers cognitive impairment such as like Alzheimer's disease or other forms of dementia. So let's see, and then there's a note here. So note, these are defined conditions and benefits, and availability may vary by the state. So for full details on the benefits and limitations, you want to see chart on page 7. Well, we're not going to get there yet. So expenses, living benefits can help you cover. So once you trigger the event, once you trigger the access to your death benefit through one of these events of a critical illness, chronic illness, terminal illness riders, once you trigger these riders, then expenses of the living benefits can help you cover. Once the money is yours, you can do whatever you want or need to do with it. So because living benefits are triggered by health concerns, the most obvious ways they're used is to pay for medical treatments and medications, but that's not all. They can help you with your insurance premiums, home health or adult daycare costs, nursing home care, loss of wages, your mortgage, other monthly bills, routine living expenses, tuition for the kids, renovating your home to make it more accessible and comfortable, entertainment, maintaining your lifestyle, vacations, and other travel. All of these can be used. So once you trigger those riders and you get access to those death benefits in your money, you do whatever you want with it. They're not telling you you can only use it for medical treatment and medications. Your money is now yours, and it is yours to do with however you feel that's going to help your life while you are living that benefits you. That is a living benefit. So how do these living benefits really work? So here's a living example. We got Jeffrey, right? Critical illness rider. He triggered it and turned it on at age 40. Jeffrey purchases an F&G life insurance policy, and at age 65 is diagnosed with invasive cancer. So he purchased it at 40. Now at 65, he ends up with cancer. So his F&G life insurance policy includes a benefit for critical illness. He chooses to exercise part of his death benefit through the critical illness rider to help cover expenses while he continues treatment. So let's take a look at the potential benefits he receives. So the base policy and death benefit is $400,000. The cash surrender value is $245,732. Jeffrey accelerates a portion of his death benefit, equaling $333,333. Jeffrey receives a benefit amount of $215,358. So after using his living benefits, Jeffrey has a remaining death benefit of $66,667. And then his cash surrender value now is at $40,955. So meaning when you trigger these and you have your death benefit, and then you have your cash surrender that's built up in there, what you're doing is you're accessing that and you're using the money while you're living. And then whatever's left, so if he were to die, then this is what's left that's going to go to the beneficiaries. And also, mind you, he might have other policies in place that leave his beneficiaries a nice amount of money upon his death. Like, say, he might have other, life insurance policies with, $400,000 also benefits, death benefit, $100,000 death benefit. So sometimes people do actually have other policies in place, and then they have this policy in place because you can have more than one life insurance policy. So then when you have this type of policy in place, and then because maybe things run in your family, you know that cancer runs in your family, you know that you have certain things that run in your family, and there's that potential risk that you too can encounter these such things. And so having hindsight 2020, you get one of these at a younger age while your health qualifies you, and you lock it in with your health, and you do it while you're younger, which is where you want to do it. So if you are in your 20s and you are in your 30s, in your 40s, this is the good time to lock in your health and get such a policy. And then you can get other policies when, if you know that you're going to have, other death benefit policies that can be left behind to your beneficiaries. And then this would be something, purposeful for building that cash value bucket, and then having that death benefit so that if something were to happen, this is what you do with that policy. You access those riders and you use it. But still, even if something were to happen, he has this amount here left to his beneficiaries. Also, he doesn't have to pay it back. You don't have to pay it back. So now, if you want to make sure you build back that death benefit or whatever is going to be left behind, then yes, you're going to pay it back, but you don't have to pay it back. So this is your money, and that is yours to access, and then you do as you please. So just wanted to share that on this. And then here's another living example. This one here is Mary with she triggers her terminal illness rider. So Mary purchases an F&G life insurance policy at age 70. So she got it at 50, and now at 70 years old, she's diagnosed as having a life expectancy of 24 months or less. She included the terminal illness living rider as a supplement to her F&G life insurance policy. So she decides to use a portion of it to enjoy life with her family. So let's take a look at the potential benefits she receives. She has a base policy death benefit of $300,000. She has a cash surrender value of $164,176. And so Mary accelerates a portion of her death benefit equaling $250,000. So she receives the benefit amount of $228,019. So after using the living benefits, Mary's remaining death benefit is $50,000 and her cash surrender value is $227,363. So that is what will be left behind to her beneficiaries if she passes away. In the meantime, she's using her $228,000 to enjoy her life and use however she feels like it. Um, Here we got another living example. We got a chronic illness rider here, Sue. Issue date is at 35 years old. So that's why I'm saying you want to get these as lock in your health. She purchased it at 35 and then at 67 is diagnosed by a licensed healthcare practitioner with Alzheimer's disease. So now she's got Alzheimer's disease. Her family decides to accelerate a part of her death benefit through F&G's chronic illness rider to help pay for the costs of her care. And if y'all know, if you've dealt with anybody and had a family member that's had these diseases, Alzheimer's, dementia, it's not easy taking care of them. So the family decides to, accelerate that part of the death benefit. She has a base policy death benefit of $500,000, cash surrender of $352,925. She accelerates 25% of her death benefit, which is $125,000, and then she receives a benefit amount of $88,231. So her remaining death benefit is still $375,000, and then her remaining cash surrender value is $264,000. So she still has a big chunk of, if something were to happen to her and she passes away, she still has a big chunk to leave behind to her family. But if she continues to qualify for chronic illness benefits under this rider, she can accelerate up to 25% of the original eligible death benefit for $375,000. So this is how you use these for living benefits. And it just shows you here more of how this works. You got the rider, how it works, and what it covers. Once you trigger it and you get the money, then of course you're going to use it however you see fit. So just wanted to share that so that way you know. Ask your financial professional how a life insurance policy from F&G can help you protect yourself now and your loved ones in the future. So that is how you leave legacy behind. Use the living benefits, and then you trigger them if you need to. You never know. You never know what's going to happen. There is the what ifs in life. So hopefully this sheds some light to people how living benefits work in a IUL with riders and how you use it for living benefits, and that the fact that it does not have to be used all for the medical expenses. But these were 3 life examples, and these are real life examples because this does happen all the time. And if you know that things are going to maybe you have foresee in the future that you have stuff that runs in your family, I would take precaution and take protection in hand now. However old you are, the younger the better. But if you are in your 30s and your 40s and your 50s, and you're still good and you're still healthy and all those things, this you have to qualify for. So this is what your health gets you. You lock in your health and you want to get it now so that way before premiums and insurance goes up, or you don't qualify for such a thing. All other types of vehicles do not give you this type of protection. Not only that, the cash value builds, tax-free. It's after-tax money. It grows tax-free distribution, protects you from market loss. You are guaranteed no loss. When the market goes down, you lose no money, but you capture gains when the market goes up. And you cannot get this type of thing from a 401k, an IRA, or anything like that. Those do not give you these types of benefits. Yes, you might actually be able to capture more gains, but at the end of the road, it does not give you this type of protection if something were to happen, and also does not guarantee you from market loss. And so just wanted to share that. If anybody has any questions, reach out to me, shoot me a DM. And if you would like to get on a free, no cost, no obligation, um, you know, financial overview, and see if you qualify for one of these, because you want to protect yourself, your family, and have something like this in place, grow your money, and tax-free distribution. Just remember, things like 401ks, it's not how much money you um, grow, like how much money you get. Um, so a 401k might be 100,000, and then you might get 100,000 cash value in a IUL, but you know what? You're going to have to pay taxes on that 401k. So you actually do not have $100,000. You might actually have 60,000, while your $100,000 in your IUL is still $100,000. So at the end of the road, you're going to pay taxes on that money, and regardless, you do pay for insurance. But the way it works out is that you pay more in taxes. And just look at your fees that when you pay for the insurance, just look at those as taxes as well. You guys might call it a fee, and I'm paying a fee for insurance, but at the end of the road, when you pay Uncle Sam, that's a fee. They're both fees. They're just called different things. You just lose a lot more to Uncle Sam than you do paying for a product. So hope that helps anybody that might have any questions. Reach out to me if you want a free financial overview and would like to lock in one of these types of policies. And that way you have an idea of what living benefits mean and what they do in an IUL. All right. Peace.